Picture yourself in a restored Victorian mansion on a tree-lined street. The walls are mahogany. The carpets are thick and silent. Classical music plays softly in the background. You're wearing a tailored dark suit. You speak in measured, comforting tones to families during the worst moments of their lives, and they thank you for it. You provide dignity. You provide closure. You provide a service that every single human being will eventually need. There are no sales gimmicks. No Yelp reviews complaining about the appetizers. No customers haggling over prices while filming you for TikTok. This is a business built on respect, tradition, and an unshakable economic truth: everyone dies. The demographics are locked in. Baby boomers are aging. The demand curve only goes one direction. You're not chasing trends. You're not disrupting anything. You're operating a business that has existed for centuries and will exist for centuries more. That's the picture. That's what the industry associations and the legacy funeral home listings sell you. Here's what nobody shows you. A funeral home is not a death care business. It's a real estate operation wrapped around a highly regulated retail sales process that makes most of its margin on product markup and upselling during emotional crisis moments. The actual care of the deceased, the embalming, the transportation, the cremation, those are commoditized services with thin margins. The money is in the casket markup, the cremation urn upgrades, the memorial packages, and the bundled service fees. You're not running a compassionate non-profit. You're running a retail operation where the average transaction is $7,000 to $12,000 and the customer is making purchasing decisions while grieving, exhausted, and desperate to do right by their loved one. The psychological dynamics are unlike any other business. People will pay $4,000 for a casket that costs you $1,200. They'll buy the $800 urn instead of the $150 one because choosing the cheaper option feels like dishing the dead. Your profit margin lives in that gap between cost and emotion. Once you understand that, everything else makes sense. Let's start with the property. You need a building that doesn't look like a 7-Eleven. Funeral homes require specific zoning, parking for 30 to 50 vehicles, a viewing chapel, a preparation room that meets state health codes, casket and urn display areas, arrangement offices, and often on-site crematory equipment. If you're buying an existing funeral home, you're looking at $400,000 to $1,200,000 depending on location and size. If you're converting a property or building from scratch, add another $200,000 to $500,000 for retrofitting, permits, and code compliance. Before we get to the revenue model, there's a cost almost nobody budgets for: licensing and regulatory compliance. Every state has different requirements, but most demand that you or someone on staff be a licensed funeral director, which requires 1 to 3 years of apprenticeship plus passing state board exams. In states like California or New York, you'll also need a cemetery broker license, embalmer certification, and potentially a crematory operator license. The licensing process alone can take 18 to 36 months. If you're not already licensed, you're hiring someone who is. An experienced funeral directors command $50,000 to $85,000 annually because they're rare and regulated. Then there's the equipment and inventory. A hydraulic embalming table runs $8,000 to $15,000. A cremation retort, the furnace that actually cremates bodies, costs $120,000 to $180,000 if you want to bring that process in-house instead of outsourcing it. Hearse and removal vehicles, $60,000 to $100,000 for a proper fleet. Casket inventory, you need 15 to 30 caskets on display, which means $40,000 to $80,000 sitting on your showroom floor. Embalming chemicals, body bags, cosmetics, PPE, refrigeration units for body storage, that's another $25,000 to $40,000. Here's where the naive version of this plan starts to fall apart. Insurance. Liability insurance for a funeral home runs $18,000 to $35,000 annually because you're handling human remains, operating vehicles, hosting grieving families on your property, and performing medical procedures on the deceased. One lawsuit from a family claiming mishandling of remains can cost $200,000 to $500,000 in legal fees and settlements. Your insurance company knows this. They price accordingly. Add it all up. Property acquisition or lease deposits, $80,000 to $400,000. Retrofitting and compliance, $150,000 to $500,000. Equipment and vehicles, $150,000 to $300,000. Initial inventory, $50,000 to $90,000. Licensing, legal, and permits, $20,000 to $50,000. 6 months operating capital before you hit steady cash flow, $80,000 to $120,000. Total startup range, $530,000 to $1,460,000. That's not a typo. You're spending luxury condo money to open a business where your customers are dead. The financial commitment is staggering for a business most people assume runs itself. Most people who fail here don't fail for dramatic reasons. They fail because of 3 traps that look completely manageable from the outside. The first trap is the pre-need sales cliff. Pre-need sales are when people purchase their funeral arrangements in advance, sometimes decades before they die. It sounds brilliant. You're locking in future revenue, getting cash now, and building customer loyalty. Except most states require you to place 70% to 100% of pre-need funds into a trust account that you cannot touch until the customer dies. You get the commission, usually 10% to 15%, but the bulk of the money sits in a trust earning minimal interest. If you sell $200,000 in pre-need contracts in your first year, you might only receive $25,000 in actual accessible revenue. The rest is locked away. Meanwhile, you still have payroll, utilities, and debt service due next month. Operators who lean heavily on pre-need sales to generate early revenue find themselves cash-starved despite having hundreds of thousands in sales. The trap costs you $60,000 to $100,000 in operating capital shortfalls in years 1 and 2. The second trap is cremation margin erosion. Cremation rates in the US hit 60.5% in 2023 according to the National Funeral Directors Association, up from 27% in 2001. That trend is accelerating. Cremations generate $1,500 to $3,500 in revenue compared to $7,000 to $15,000 for traditional full-service burials. As cremation becomes the default, your average transaction value collapses. If you built your financial model assuming 50% traditional burial and 50% cremation, but the market shifts to 70% cremation in year 3, your annual revenue can drop by $120,000 to $180,000 with zero change in call volume. You're serving the same number of families but making half the margin. The third trap is the competitor consolidation squeeze. Large publicly traded funeral home chains like Service Corporation International and Carriage Services have been acquiring independent funeral homes for 2 decades. They have economies of scale you cannot match. They buy caskets at 40% less than you pay. They centralize embalming. They negotiate better insurance rates. When a chain opens or acquires a location 3 miles from you, they can undercut your pricing by 15% and still make margin. You cannot. Independent operators in markets with aggressive chain competition see revenue drop 20% to 35% within 18 months of a new competitor entering the area. That's $80,000 to $150,000 in lost annual revenue that never comes back. Here's the part that changes how you see this entire business. Funeral homes make money on 3 distinct revenue streams, and only one of them is actually profitable at scale. First, service fees. This is your facility charge, staff time, coordination, transportation, and filing death certificates. Service fees range from $1,500 to $3,500 depending on complexity. Your margin here is 30% to 40% after labor and overhead. Decent, but not enough to build wealth. Second, third-party goods and services. This is everything you're coordinating but not providing: flowers, obituary notices, clergy honorariums, cemetery plots, death certificates. You're the middleman. You mark these up 10% to 20%. Your margin is thin because families can easily price check. This is filler revenue. Third, merchandise. Caskets, urns, vaults, memorial keepsakes. This is where the actual profit lies. A basic metal casket costs you $600 to $1,200 wholesale. You sell it for $2,500 to $4,500. That's a 250% to 350% markup. An urn that costs you $80 sells for $400 to $800. The gross margin on merchandise is 65% to 75%. This is your profit center. Now let's do the math. Say you're averaging 120 calls per year, which is typical for a small to mid-sized funeral home. Of those, 70 are cremations and 50 are traditional burials. Cremation average revenue, $2,800. Burial average revenue, $9,200. Total annual revenue, $656,000. Sound solid? Now subtract costs. Facilities and overhead, $180,000 annually. Labor for funeral directors, admin, and support staff, $210,000. Vehicle maintenance, fuel, insurance, $45,000. Inventory replenishment, $55,000. Marketing and compliance, $35,000. Debt service on your $800,000 acquisition loan at 7% interest, $67,000. Total annual costs, $592,000. Net profit, $64,000 on $656,000 in revenue. That's a 9.8% net margin on a business that required $800,000 to enter. Here's the counterintuitive truth. The business does not scale linearly. Doubling your call volume does not double your profit because you hit labor and facility capacity constraints. You can't just do more funerals without hiring another licensed funeral director, expanding your facility, or turning families away. The one metric that actually determines success or failure is merchandise attachment rate. What percentage of families buy high-margin products from you instead of going to Costco for a $900 casket or ordering a $60 urn on Amazon? These numbers are based on industry averages and should be treated as a framework for thinking, not a guarantee of any particular outcome. Let's talk about the Menorah Chapel's collapse in New York City. Menorah was a legendary funeral home network serving the Jewish community for over 60 years. In 2009, the owners were caught in a scandal involving pre-need trust fund mismanagement. They had been dipping into trust accounts, money that legally belonged to families who had prepaid funerals, to cover operating expenses. When regulators audited the accounts, they found a $500,000 shortfall. The business imploded. Criminal charges were filed. Families who had prepaid were left scrambling. This is not a story about bad luck. This is a story about a structural problem that most people never saw coming. The owners relied on pre-need sales to generate operating cash, but the regulatory restrictions on those funds created a liquidity crisis. They borrowed from tomorrow to pay for today, and eventually tomorrow arrived. Now take Ronest, who runs a single funeral home in suburban Indianapolis. Ust figured out something brilliant in the early 2000s. He noticed that families increasingly wanted personalized memorial services, photo montages, video tributes, custom memorial websites. He hired a part-time videographer and graphic designer. Started offering premium memorial packages for $1,200 to $2,500. These services cost him $200 to $400 in actual production but carried emotional weight that justified the price. Within 3 years, 60% of families were buying memorial packages. That added $90,000 in annual high-margin revenue without adding facility costs or licensed staff. Ust understood that the business wasn't about death. It was about memory, identity, and helping families process grief through personalized ritual. He's now grossing over $1,200,000 annually from a single location and owns the building outright. The operators who actually build wealth here are not necessarily the ones running the biggest operation. They are the ones who asked a different question. Not how do I serve more families, but what adjacent services can I monetize using the same infrastructure? First, aftercare, grief counseling and support groups. Most funeral homes offer this for free as a community service. Smart operators formalize it. Hire a licensed therapist to run weekly grief support groups. Charge $40 per session or $150 for a 6-week program. You're already hosting families in your building. You already have the space. Add 30 participants per month and you're generating $14,400 annually in pure margin. It sounds small. It compounds. And it builds deep loyalty that drives referrals. Second, estate services coordination. When someone dies, the family faces a nightmare of administrative work, probate, asset liquidation, property cleanout, document filing. Partner with estate attorneys, senior move managers, and auction houses. Offer a full-service estate coordination package for $2,500 to $5,000. You're not doing the work yourself. You're the general contractor coordinating specialists and taking a 20% to 30% coordination fee. 10 estate packages per year adds $25,000 to $50,000 in nearly pure profit revenue. Third, green burial and alternative disposition services. Alkaline hydrolysis, human composting, and conservation burials are legally available in a growing number of states. The equipment for alkaline hydrolysis costs $150,000 to $250,000, but the process generates $2,500 to $4,000 per service with a gross margin of 60%. Early adopters in states like Washington and Colorado are capturing a premium market willing to pay more for environmentally friendly options. 5 alkaline hydrolysis services per month adds $150,000 in annual revenue with minimal marginal cost once equipment is installed. 4th, celebrant and officiant services. Religious affiliation is declining. Families increasingly want customized, non-religious ceremonies. Train your staff as certified celebrants. Charge $400 to $800 to design and officiate a personalized service. Material cost is zero. It's pure labor margin. Offer this to 40% of families and you're adding $20,000 to $40,000 annually. Here is the honest math, not the pitch deck version. The real version. Good year scenario. You're in a stable market. Demographics are in your favor. You handle 135 calls. Cremation rate holds at 65%. Your merchandise attachment rate is strong because you've built trust in the community. Revenue breakdown: 88 cremations at $3,200 average and 47 burials at $9,800 average. Total revenue: $742,600. Costs remain relatively fixed. Overhead, labor, and debt service total $598,000. Net profit: $144,600. That's a 19.5% margin. On a $900,000 initial investment, you're seeing a 16% annual return. Strong. Bad year scenario. The county opens a low-cost cremation provider offering direct cremation for $695. No frills. No service. Just cremation. Suddenly, price-sensitive families have an option that undercuts you by 60%. Your call volume holds steady at 130, but now 95 of them are cremations and many are choosing bare-bones packages. Revenue breakdown: 95 cremations at $2,100 average and 35 burials at $9,200 average. Total revenue: $521,500. Your costs don't compress much. You still need licensed staff, facility maintenance, insurance. Costs drop slightly to $575,000 because you're buying less inventory, but you're underwater. You're losing $53,500 for the year. Now we get to the number that actually determines everything. The gap between these two scenarios is $198,100 in annual profit swing. What causes it? Factors almost entirely outside your control. A new competitor entering the market. Shifts in consumer preference toward cremation. Economic downturns that push families toward cheaper options. Regulatory changes that allow new disposition methods. You can control your operations. You cannot control the market dynamics that determine whether you're printing money or bleeding cash. The person who wins in this business is not the most empathetic or the most operationally efficient. The person who wins is the one who understands they're operating a local monopoly on trust during crisis moments, and they've built a reputation fortress that insulates them from price competition. They've been in the community for 20+ years, or they've acquired a legacy brand that has. They sponsor little league teams. They sit on non-profit boards. When someone dies, their name is the first one families think of, not because of Google ads, but because of decades of embedded social capital. They're not competing on price. They're competing on "this is who our family has always used." They also have diversified revenue streams that don't depend solely on call volume. They've built the grief counseling programs. They've integrated estate services. They've carved out a niche. Maybe they specialize in veteran services and have deep VA connections, or they serve a specific cultural community with customs that require specialized knowledge. Here's the counterintuitive truth: the best operators are not emotionally numb to death. They've learned to see their role as economic choreographers of grief ritual. They understand that families don't want the cheapest option. They want validation that they're honoring their loved one properly. The operators who succeed give families permission to spend by framing purchases as acts of love, not transactions. So let's go back to that Victorian mansion. The mahogany walls. The silent carpets. The families thanking you during their worst moments. You see it differently now. That building isn't a serene sanctuary. It's a 7-figure capital investment with regulatory compliance requirements and competitive pressures you can't control. Those families aren't just grieving. They're customers making high-stakes purchasing decisions under emotional duress. And your profit depends on steering them toward premium merchandise while maintaining the appearance of compassionate guidance. The business isn't death-proof. It's death-dependent, which is different. Demand is guaranteed, but margin is not. Cremation is cannibalizing your most profitable service line. Chain consolidation is squeezing independence. Low-cost disruptors are turning death care into a commodity. The operators who build wealth here aren't the ones who love the work. They're the ones who understood early that this was never about death. It was about trust, timing, and the economics of selling dignity to people who have no choice but to buy. You can build a solid living here if you enter with clear eyes and patient capital. You can even build wealth if you diversify, dominate a local market, and hold long enough for the real estate to appreciate. But the fantasy version, the passive, recession-proof, print money while you sleep version, that's not real. What's real is this: you're operating a retail business with the highest possible emotional stakes, the thinnest margin for error, and customers who will never come back. In most businesses, that's a fatal flaw. In this one, it's just the truth of what you signed up for.